Welcome to this month's Market Update. I'm joined today by KC Lowe, Principal Consultant with Frontier Advisors. Hi there, KC.
Wayne?
Well, as we start a new calendar year, the Reserve Bank will be in the focus of many commentators, and they've had their first meeting for the year, an important one for the RBA, right?
Yes, that's right. It's also important to note that this was the first meeting under the new structure. So instead of just having a few hours to do to conduct the meeting, the meeting now goes over 2 days, so starting Monday and then finishing Tuesday for the announcement. The other change is that rather than having 11 meetings a year, they will now have only 8 meetings a year. So, it's the first meeting of the year, but it's also the first meeting under the new structure. But in terms of the cash rate outcome, which was, expected by the market, the Reserve Bank of Australia left the cash rate unchanged at 4.35%.
Yes.
But it's important to read into the announcement to get more of the color and then how the Reserve Bank is thinking about the outlook for the cash rate. So the first thing to highlight is that on inflation, they do say that it is moderating, but it is still at a high level. So that's telling us that the Reserve Bank is still concerned around inflation, even though the direction it's going in, it's the right one that they like. The other thing is that when you dig into inflation, they are concerned about the services component of inflation or the non-tradables component, where they say that services inflation is still decreasing at a much more gradual rate. So they're concerned that that could be a bit more sticky, keeping the overall inflation level higher. So there's some concerns there. The other statement that they included this time, which wasn't previously included, was that further rate hikes cannot be ruled out. So even though it does seem like overall it's likely that we are at the peak of the interest rate cycle, the Reserve Bank wants to tell the market that, hang on, wait, the next move is not necessarily going to be down. There's still risks in the economy, and we're still data dependent, watching what's happening in inflation, what's happening to growth. So it's just trying to tell the market not to get ahead of itself in terms of rate cuts to come.
So obviously RBA signals are critical for Australian investors, but you're looking at central banks around the world. How are their policies and their signals differing, or how are they the same for what you're seeing come from the RBA?
So similar to the Reserve Bank of Australia, I think there's the two key themes playing out for central banks in these key developed market economies. The first one is it does look like the interest rate cycle is at its peak now. But we can say that because most of the central banks over the last few months have left their cash rates unchanged.
Yes.
The other key theme is that central banks are pushing back on market expectations in terms of rate cuts that's expected to happen this year. So, when we look at the Bank of England, they're saying that not there yet in terms of potentially cutting interest rates. And when we look at the European Central Bank, they've said that rate cut discussions are premature at this stage. And then if you look at the US Federal Reserve, yes, the chair did say that the interest rate cycle is likely at its peak, but he has strongly pushed back against market expectations of cuts happening starting in March. He said that that's quite unlikely based on their assessment of the US economy at this stage. So yes, the US Fed has left the cash rate unchanged, but they also push back on any cuts that could happen anytime soon.
So staying in the US, of course, last year we saw some interesting developments, some challenges, if you like, at parts of the US banking sector. Still some challenges there, aren't there?
Yes. So that's a good point. So as our viewers may remember, about 12 months ago in February, March, some US regional banks ran into trouble. Specifically, Silicon Valley Bank and Signature Bank both collapsing. One of the key reasons for why they collapsed was the rapid increases in interest rates, particularly for long-term government bond yields, which led to a material drop in the value of these banks' investments into government bonds. So that was one of the big issues at that time. And that issue is still playing out because interest rates are higher today compared to 18 months, 24 months ago. But the other big issue that's playing out that's likely to impact the regional banks more in the US is their commercial property debt investments, specifically the office property debt investments. Because as interest rates have increased, a lot of these office property owners are finding it harder and harder to repay the interest on these loans. And over the last 12 months, we've actually seen some office property owners just give up on trying to repay the interest and actually just handed the keys to the property to the banks.
Yeah.
Now, one of the issues with this is that because of the working from home trend post-pandemic, there are fewer tenants in these office properties now. Based on some of the data that we track in terms of the US across the key cities, it looks like office occupancies are about 50% of where they were pre-pandemic. So 50% lower than what they were before the pandemic, which means that a lot of these properties, in terms of the value, some of them are now worth less than the loans that were given to them, which is a big issue for the banks because they will have to register or record losses on these loans. Which, over the past few weeks, we saw one bank make that announcement, the New York Community Bank Corp, which the market reacted very negatively. So their share price fell more than 30% on the day when that announcement was made. So that's an ongoing issue, and it's definitely a space to watch going forward.
Well, inflation and interest rates impact so many parts of economies and markets around the world. Thanks for raising a couple of those issues for us today, KC. And thanks for taking the time to watch this month's Market Update.